Hey everyone, excited to be back for this week's edition of Frequently Asked Questions for Commercial Real Estate. In today's video, I thought I'd do is talk about the concept of financing. In particular, when I talk about financing, I really want to talk about the documents that you need to provide a lending institution in order to expedite the process of actually securing a commercial loan. And I'm often met with pushback from this from various different clients, whether they're business owners or investors, and they often say, well, why do I have to share all this information with them? I mean, I don't necessarily feel comfortable doing so. But what people fail to understand is that banks are not a charity. They want to make sure that if they do issue a loan, you're able to fulfill on that obligation. You're able to make your monthly payments and over time pay off the loan, and therefore that's a good investment on their end. So prior to actually looking to secure a commercial loan, these are the three documents you need to have ready to go and accurately drawn up so that banks can be able to expedite the process of actually issuing you a loan. So to start off, the first thing you need to consider is a personal financial statement. Now you may be asking, what is a personal financial statement? Well, a personal financial statement is a document that outlines your assets and liabilities. So let's unpack each one of those things so you understand what they are. An asset is something that has value in the marketplace. So for example, a house, if you own a $200,000 house, you have a $200,000 asset. Now on the other end of the spectrum is a liability. What a liability is debt, is essentially debt. So in the case of this housing example, if you have a $150,000 mortgage on that house, that's a $150,000 liability on the other side of the equation. So what a personal financial statement does, and this is what banks look for in particular, is to see what is your net worth. So your assets minus your liabilities. So in this example, let's take the housing example for just as an example. If you have a $200,000 house and that has a $150,000 mortgage on it, you have a net worth of $50,000 if that's the only other things that you own. Now, the reason why banks like to look at this number is because it gives them safety as far as like if you were to not be able to pay on your mortgage or you're not able to comply with the terms of the agreement, they're able to have recourse or come after those personal assets to be able to recoup their loan. So if they're going to issue a $500,000 loan, they're probably going to want to see that your net worth is in excess of that, or the net worth of those involved in the transaction is more than that. And that, again, that just gives them comfort in knowing that they can come after those assets if for some reason you're unable to comply with the requirements of the loan agreement. So that's number one, is a personal financial statement. Number two is your tax returns. Now you may be asking, why do they want to see your tax returns? Well, what they want to see is that your income, whether that's from your job or your business or whatever, is stable and consistent over time. Or if it's not necessarily stable, it's at least starting to increase over time. What they don't want to see is that you make a ton of money one year and then almost no money the next year, and there's just a lot of volatility. The reason why this gives them moments to pause is because it's like, okay, well, they may not be able to replicate that great year this coming year, and how does that affect their ability to be able to service the debt? How does that affect their ability to be able to pay the mortgage on the property? So number two is tax returns. So they're generally going to want to see the last few years of tax returns, most likely 2 to 3 years, just to make sure that, number one, it's either stable income over time, or even better is to see income increasing over time, knowing that, okay, they're going to be able to service that debt whenever it comes available. So that's number two. Number three is going to be your profit and loss statements. Now, what is a profit and loss statement? If you're a business owner, a profit and loss statement is going to be the total revenues and expenses of your business over a period of time. Generally speaking, they're going to want to see between 12 and 24 months of your profit and loss statement, just to make sure that your business is healthy. If you're going to be buying a business, or if you're going to be buying a building, they want to make sure that your business can support the additional expense of a mortgage on the property. So that's number one if you're a business owner. Number two, if you're an investor, they're going to want to see the profit and loss statement of that investment property. So for example, if you were going to buy an apartment building, they want to make sure that that apartment building, the income produced by that apartment building, is enough such that it's able to pay off the mortgage on a monthly basis. So with a profit and loss statement, you're going to probably need either an accountant or a bookkeeper to keep the records straight, such that as you approach a bank and you're able to provide them with these accurate documents, they're able to make an accurate judgment on whether or not to issue a loan of a particular amount, given their criteria for debt service. So number 3 is a profit and loss statement. So hopefully you gained some value from this video. If you like this channel, feel free to like, share, and subscribe to this channel. I love providing awesome and engaging content related to commercial real estate. If you are in the market, in particular in the Louisville area or its surrounding areas, feel free to reach out to me. My number is 502-536-7315. I'd be happy to help you either buy, sell, or lease commercial property. And I guess we'll see you guys next week. See ya.